Hey guys, welcome to Margin Hub. Here today I'll teach you how to trade on Deriv with Volatility 25 1-second index using a simple strategy. If you like this content, please like, subscribe and share this video as it helps me out a lot. Now onto today's lesson. Firstly, you want to make sure you are on Volatility 25 1-second index. This strategy can also be used on the other volatilities offered by Deriv, such as Volatility 10 index, Volatility 15 1-second index, and even Volatility 50 index, but it works best on the Volatility 25 1-second index, so make sure that you have it opened up on your charts. To do this, look at the top left corner of your chart, and it should be indicated. Now, after selecting Volatility 25 1-second index, make sure that you set your chart type to candles and that you are on the 1-minute chart. This strategy targets 1-minute trades. We will also set our trade expirations to 1 minute. When trading using volatility indexes, it's important to know exactly what your trade bias is before you enter a session and choose your expiry. This is a very important step, so make sure you take note of it and do not skip it. Now we will come on to our indicators. This is a simple setup that requires only 3 indicators, and our entire strategy is to try and time our trades according to our indicator in our directional bias. To create this setup, open the Indicators tab on the right panel of the chart and search Moving Average. Click it 2 times to open 2 moving average indicators. Next, open the Stochastic Momentum Index. For the settings, click the gear icon on the first moving average indicator, indicated as MA on your active indicators list. Set the color to red and set the period to 8. Make sure field is set to close, type is set to simple, and offset is 0. Next, open the settings for the second moving average indicator, indicated as MA1 on the active indicators list. Set the color to green and set the period to 14. Leave the rest as is. The confluence of these 2 moving average indicators will serve as triggers to enter trades. Lastly, open the settings for the Stochastic Momentum Index. Set the K period to 12 and the D period to 21. Change the color for overbought to green and oversold to red, and leave everything else the same. With our indicators locked, our priority is establishing our directional bias. This isn't a guess, it's the macro narrative dictating every execution, ensuring we align with dominant order flow instead of fighting it. If structure is bullish, our technical rules force us to hunt exclusively for rise contracts. If it shifts bearish, we pivot entirely to fall contracts. Anchoring to a strict bias eliminates emotional guesswork, allowing us to trade purely on statistical probability. To put it simply, if the market is going down, we hunt for fall trades, and if the market is going up, we hunt for rise trades. In order to find out our directional bias, we first have to do a top-down analysis, where we look at larger timeframes on the charts in order to find out how the market is moving on a macro scale. In our case, we don't need to look at charts any higher than the current 1-minute chart, because we can clearly see that the market is bearish and is moving downwards. Because of this, we will be hunting for full trades. And now here comes our strategy. Firstly, before we place a trade, we have to look at our moving average indicators. Whenever the red moving average line is above the green line, it's our first signal to enter a trade. The indicators show that the current market levels will continue going down. If the green line is above the red line, it means the market is bullish and is your first signal to not enter the market. Next, we look at our stochastic oscillator indicator. With this strategy, we will only enter trades if charts indicate that the asset is overbought, which we can see if the white line crosses the green line. This is because if the asset is overbought in a bearish market, it's a strong signal that the price will be rejected, and the likelihood of price dropping is extremely high. Therefore, it's a high probability signal for us to enter a full trade, so we will place a contract worth $100. As you can see, we successfully made $100 using this simple strategy on Deriv Volatility 25, 1-second index. This high probability setup is designed for beginner traders who are just new to Deriv markets. Consistency in these markets isn't about chasing a single lucky win, it's about strict risk management and unwavering discipline over a massive sample size of trades. Lock in your data, protect your capital, and I'll see you in the next breakdown.